Hello, everyone, and a very warm welcome to the ICICI Prudential and CNBC-TV18.com presents Smart Investor, an exclusive investor education series where industry experts discuss the importance of financial independence and also make you understand about the right habits that one can cultivate to achieve it. As we celebrate the nation's 75th year of independence with the Azadi Ka Amrit Mahotsav, we are here with industry experts who can enable you to achieve financial independence, because that is just as important. So if you're keen to invest your money but don't know how and you don't know where to start, well, then we've got you covered. And I'm your host, Ruchira. So let's begin with our discussion today. And the theme for today's discussion is India at 75, Unlock Your Financial Freedom. And for that, I have with me a very special guest, Ms. Hansi Mehrotra, founder and editor at Money Management India. Welcome to the show, Hansi.
Thank you. Thank you, Ruchira. Good to be here.
It's great to have you here with us, and we have lots and lots of questions lined up from our audience and generally to understand what is financial independence. So let's start with a very basic question. One of the biggest drawbacks when it comes to anything to do with finance is lack of awareness and a general kind of a herd mentality. We often tend to just blindly follow whatever our friends or family are doing. So how would you, as an expert, define financial freedom, and how do you think one can work towards achieving it?
Great. As you said, I think we follow others, and that's something that we should stop doing. I think we have to decide for ourselves of what actually makes sense for us. So I actually define financial freedom at three different levels. One is something that is just being able to manage your day-to-day expenses and withstand financial shocks. That ability is something that everyone must have. To me, that's just very basic. And then there is kind of like, am I able to live the way I live currently while renting a bunch of things, whether it's a car, whether it's a home, whether it's whatever. So that's kind of like the second level, kind of financial freedom. And the third level is being able to meet all your goals. If you want to get to a certain career, if you want to travel, if you want to have some assets, those are things that you can sort of define for yourself. The crux though is that you define it for yourself. We were joking about my hair. I wanted my hair to be like Deepika Padukone's. Now, that's, to me, it's a minor thing. But if I start saying that I want to live the lifestyle of a Deepika Padukone, obviously I can't. Okay, I just don't have the same career as her. So similarly, I can't obviously have her assets. I can't have her sort of lifestyle. So defining that. So like I said, the three levels: basics, being able to meet your current needs, and then being able to fulfill all your goals. Now, within goals also, there are sort of different types of goals. There's nice to have, and there's kind of wishful thinking. And the way you plan for it will be a little bit different, because if you go after like your highest goals, imagine you have like, oh, I want to own a jet and I want to have an apartment in Paris. And if you start planning towards that, it's like you're over sort of, I mean, if you can get there, nothing like it. But yeah, it's very hard to get that. So you have to make the game winnable. Very important for our psychological sort of thing, that set a goal that is within, just outside of your reach. So it is winnable if you stretch yourself a little bit. If it is too far out, it just becomes a dream. You have no chance of then sort of getting there. So yeah, so there are the three levels that you have to define for yourself, and it'll be different for you, it'll be different for me, it'll be different from someone in Kanpur, and it'll be different for someone in whichever part of India they're in.
Sure. Thank you, Hansi, for that. And very rightly said, people have different incomes, different needs, goals, and risk appetites. So obviously, what financial independence really means also differs from person to person. And clearly, a one-size-fits-all approach will not work then. But if I were to ask you another rather basic question, what is the difference between savings and investment? And how can one really begin their investment journey? Because there are so many options available. So how does one make the right choice in order to achieve financial independence?
Okay, so there are a bunch of different questions there. So if we work backwards from, okay, this is where we want to get to the financial sort of independence sort of thing. There's a bunch of steps that you have to take to get there. One, like I said, the basics is to be able to have control of your cash flow. So budgeting is very important.
Right.
The ability to withstand shocks. So having some insurance or an emergency fund is very important. So have those two things in place before you can even think about investing. Okay, so investing is the third step. So make sure you have these two in place. Once you have, and to get to the emergency fund also you have to save. So if, for example, if you're earning 100 rupees a month and spending all of 100 rupees, then you don't even have an emergency fund, right? So make sure you save. And the emergency fund, you would simply need to save and put it into a bank account, maybe a fixed deposit, maybe a liquid overnight type fund. Okay, that's
All
the
right.
extent to which you need to invest or optimize your earnings from that. Okay, don't go any cuter than that, no matter what people tell you. It's okay to be a little bit tax inefficient, but don't go beyond these, because anything beyond this starts taking on risks that you will not be able to handle should you need it in an emergency. So this is the emergency fund. Once you
All right.
have this sorted, then you can start building your investment plan. And this is where you need to figure out who you are, right? Are you a 21-year-old with your whole life ahead of you? Do you have your human capital? Do you have a good education? Are you able to get a job that will pay well? Or are you someone in your 40s, midlife? Are you someone close to retirement? Are you someone in retirement? So obviously, for each one of these sort
Life
of profiles,
stages, yes.
it will be very, very different.
Mhm.
So now, depending on where you are, so I actually have something here that I don't know if you can sort of see. Let me see if I can show this to you. Okay, can you see this?
I could, yeah, yeah, yeah. I can
It's a
see it.
little house. Okay, so this is something that I sort of use as just an explanation sort of thing. So
All right.
basically, your foundation is your emergency cash and
All right.
your insurances and your human capital. Okay, so put that under the ground, hide it. Then basically the two pillars are the your growth pillars. One of them is ability to earn more income yourself, and
All
this
right.
is your investment portfolio. I've made it blue because the idea is to make it into a blue chip,
Mhm.
relatively safe sort of. Let me move this a bit closer. So make this sort of investments in for the
Mhm.
long term, and then
All right.
you also need the chance to make money, and that's your fun roof. Okay, so
All right.
even if you are in your 20s, 30s, 40s, doesn't matter. You
Mhm.
can't kind of just have like, oh, I will save and put my money away, and that's it. That's not enough. So investing definitely, but also put some amount of money where it's at either your career or your hobby or your own business, something
All right.
where you can create extraordinary wealth, because
All right.
your investment portfolio can manage your wealth, can enhance your wealth, but it can't create wealth. It can't
That you
actually,
have to do, yes.
yeah, it's that's not going to get you from one strata of socioeconomic class to another strata. That won't happen with mutual funds. We'll get to
Mhm.
that. But what I'm saying is, therefore, always ensure to have fun. Now,
Mhm.
depending on where you are, if you are close to retirement, okay, so whether it's early retirement like me or whether it's normal retirement, then you'd convert some of your growth assets into income assets. And then the house looks like this. Now,
All
the
right.
exact proportion will vary depending on who you are, but that's the rough idea of a house. So, answering now your question about saving versus investing,
Mhm.
in the red you are saving, and
All
once
right.
you get to the blue, the pillars, you're basically taking your saving and investing is basically putting your money into something which is an
Mhm.
asset that gives you returns. Okay, so when you take your saving and put it into an asset where your capital then starts giving you a return, that is called investing.
All right.
Investing can be in equities, investing can be also in real estate, also in debt, and also in
Mhm.
alternative asset classes. But by and large, you want to invest. What people mean is really investing in equities. But like I said, debt
All right.
technically is also an investment.
Mhm.
Sense?
Sure. That was a very interesting analogy, and thank you for showing that demonstration, with these various blocks of a house, which could actually denote our financial freedom. And I totally agree with you. Millennials have different financial goals from, say, Gen Z or the earlier generation. financial goals, dreams also depend on income and life stages. Like you might want to save for retirement, or you might want to save for a child's education abroad. But broadly, what are the 5 key habits that one should work towards inculcating to really reach their goal of financial freedom? Something like that we can use as a rule of thumb.
Okay, I don't know about 5. Let's start with sort of 2 or 3 that are very, very key, that I think if you master them, you've actually sort of well on your way. The first is that you need to always save. Okay, so think about why you need to be involved in finance at all. You work from age 20 to age 60, give or take 5 years, right? From 25 to 65 or 20 to 60, whatever. And you have another 20, 30 years after that that you're not working, assuming that
Correct.
your health is such. So basically, if you take a rule of sort of 40 years of working and another 20 years of not working, so roughly 2/3, 1/3. So basically, if you work for 2/3 of your life, you need to be able to save for 1/3 of your life. So 1/3 of savings is a good rule of thumb that if you follow throughout your life,
All
you'll
right.
be fine, because then your spending habits are
Mhm.
basically always only 2/3 of what you earn. So if you earn 100 rupees, make sure you never spend more than 2/3 of your 100,
All
67
right.
type, and you save 1/3, which
Mhm.
means that whatever you are, whatever habits you take on, like in terms of spending, you're always in check. So that's habit number
All right.
1. Always save 1/3.
Sure.
The second habit is, I would say, don't compare yourself with others. That's something that we were just talking about a few minutes ago. Just because somebody else has a new car, somebody else has a new house somewhere else, somebody else has new clothes, somebody else drinks or eats out every day, it's not, they have their lives, you have your life. So stop comparing yourself to others. Easier said than done. I totally get, in the Instagram world, you are consciously looking at sort of other people's lives, so it's hard to be
And
not
being
influenced by
influenced.
them.
Yes.
But you have to develop this habit that you have to find your own happiness. You cannot
Sure.
be going and looking at somebody else's.
All
The
right.
third is investing. Okay, so turning that saving. So once you've saved 1/3, like I said, build your emergency cash, pay your
Mhm.
insurances. Once you're done with that, then start investing. Okay, start your SIP, which is a systematic investment plan, straight away into, and here's the crux, I would say, start with a simple index fund,
All
because it
right.
is simple. Okay, so you don't have to use your, what happens is, all of us, when we see something too complicated and we
Mhm.
have to then study it, we end up procrastinating. Okay, so
Yes.
the simple trick is to get started. So start with a simple index fund, with
Mhm.
maybe to start with, maybe a sort of a large cap index fund to start with, and then you can add more and more to it. And then over time, obviously, watch programs like this, learn a little bit more about what kinds of mutual funds they are and how to invest and so on. And
All
then
right.
you can add more to it. So what I'm saying is, start simple and then you can add more to it. But
All right.
don't fall into the trap of trying to study everything up front. So that's the third
Definitely.
habit.
Yes. All
The
right.
fourth is, I would say that while you are still sort of planning, you can also think ahead and say that if you are in a steady job and you know that every year you tend to get an increment, you can
Mhm.
start planning about investing that as well. We can talk about that. So there are the few different habits that I would say are very, very important. And if you master these, I think you're well on your way.
All right. So actually, you were just talking about mutual funds, and that is my next question. That people kind of get a little daunted when it seems like a daunting task to invest in mutual funds, because most people don't have enough knowledge, or they're not backed with enough data. So, if you had to introduce our audience to the concept of SIP and mutual funds, how would you do that? And what about debt funds, equity? There's REIT. There's so much to choose from. So how does one really begin their journey?
Hmm. Okay, so firstly, let's clarify what is a mutual fund. Mutual fund is simply a vehicle where other people like you and me are pooling our money and we're giving to a professional manager. So mutual fund is not an asset class. Okay? It Mutual funds do not give returns. Mutual fund don't have risks. So when people say, oh, mutual funds are risky or they give 15% return, No, 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 no. There are different types of mutual funds. You can have an equity fund, you can have a debt fund, you can have a real estate fund, you can have all kinds of funds, but mutual funds by themselves don't have any returns, don't have any risks. They are just the vehicle. Okay. And you're appointing a professional fund manager to manage money on your behalf. Now, why do you do that? You do that because, like, you may be a doctor, lawyer, dentist, artist, actor, all kinds of things. Just like you are good at what you do, similarly, professional
That's
fund
good.
managers are good at what they do. Okay,
Yes.
so don't assume investing is something that ek do kitab padha, ek do books padha, and again you sorted. No, investing is a skill. In fact, it's one of the hardest skills to master. It's one of the easiest and yet the hardest. It's actually quite a fascinating place, which is what why I like it, about it. But the point is that as you put more and more money, it gets harder and harder. So when you give it to a fund manager, they have a qualification, they have
Yeah, the
rules,
skill
they have
set.
a structure, they have research, and they go and manage the money. And their objective, now the mutual fund, I guess when you're buying a mutual fund, you're buying two things. One, you're buying the return of the market. So
Hmm.
when I say, for example, the equity fund, they are funds that track a particular market index. Market index is basically a hypothetical basket of stocks that
Yes.
represents a big proportion of the market. So the Sensex represents the largest 30 stocks. The Nifty 50 represents the largest 50 stocks. Then
Yes.
there's a BSE 100 or NSE 100, and then there's a 200, there's a 300, there's a 500.
Hmm.
So the broad market is considered 500 stocks. So the largest 500 stocks in any country tend to represent, by and large, pretty big part of the economy. Okay.
Hmm.
So what you can start with is start with an index fund that tracks that. But then there are issues with that. Sometimes they're not able to track that. So when you give it to a professional mutual fund manager, they are trying to match the return of that index, and they're adding 2, 3, 4% above that. Okay, and I say 2, 3, 4% because depending on what segment, their ability to add value over and above the market return is limited. So
Right.
um, within the equity market, for example, we divide it up into large stocks, large cap
Hmm.
stocks, which is the largest
Yes.
100 stocks. Then there's the mid cap stocks, which is the next 100 stocks, and then or 100, 150 stocks, and then below that are the small cap stocks. So professional fund managers are able to barely outperform the large cap, outperform
Correct.
by 2, 3% on the mid cap, and then another sort of 3, 4% on the small cap. So what I'm saying is that mutual funds do have um, l- sort of a learning curve. So
Correct.
you will need to understand that a little bit more, and that's an equity funds, right? And then there's similarly in debt funds, there are different kinds of debt funds, and they also sort of increase in risk and therefore increase in return, and so on. So there's a learning curve that you should sort of definitely spend time on,
Hmm.
but it's not something that you will understand on day one, and neither should you try. So,
So
like
it
I said,
might be
start.
smarter to give it to a professional to manage your money, or maybe use their research and their skills.
Yeah, but so yes, I agree, definitely. But uh, so a professional, you mean a professional fund manager? We're giving in mutual fund anyway, right? So we are starting
Mhm.
a sort of a sort of up lump sum money and then putting in SIP. Yes, you should also consider getting a financial advisor. Now,
Mhm.
the thing with financial advisor is there are different levels of skill, qualification, and licenses. Okay,
All right.
there are two types of licenses in India. There is
Mhm.
the mutual fund distributor license, and
All
there
right.
is the registered investment advisor license. Okay, that means that they get compensated slightly differently. In the mutual fund distributor license, they get a trail commission from the mutual fund when you put money into a fund. Whereas in the registered investment advisor license, you have to pay them by check. It
All
hurts
right.
more when you write the check, but it ensures that they're sitting on your side of the table. With a mutual fund distributor license, it doesn't mean necessarily that they're sitting on the other side of the table, but you have
Mhm.
to take into account that they are you they have a slight incentive to recommend funds in which they get higher commission. It's
All
possible.
right.
So you have to allow for that possibility, which means that if you are in fact giving it to MFD, work on your end is a little bit harder in that you have to keep a check on them on their
All right.
skill, on their qualifications, on their incentive. You need to kind of keep checking on them. Whereas when you are with an RIA, it's a
Mhm.
little bit more, you've paid them, so they have all the incentive in the world to be on your side of the table. Okay, so I'm
All right.
not saying one or the other. I'm just simply saying there are the pros and cons in choosing one or the other. And even then, and even if either of them have do the right thing, um,
Mhm.
selecting of mutual funds and what risks they are is an evolving thing. Just like
You have to keep
you
working
wouldn't
it.
want to deal with a doctor who got their MBBS some 20 years ago, 30 years ago, and doesn't study a journal. ऐसा नहीं होता है, right? Similarly,
Mhm.
you want to work with someone who is always on top of what is going on and
Absolutely.
yet has a temperament. They need to
Mhm.
have the same bedside manners as a doctor, which means don't panic. Okay, markets crash. The last thing you want is your own doctor to panic or your own financial advisor to panic, right? So I'm saying to
Right.
you that there's a bunch of different things that you need to take into account when you're selecting your advisor who can help you
Mhm.
with these things. So
Definitely.
definitely, yeah.
Great. Thank you for sharing those tips. Very, important and pertinent tips shared by you there. But coming on to you were talking about SIPs. So could you take us through the SIP top up feature and also explain that how soon can one expect to gain if we do a long term planning with SIP or mutual funds?
Okay, so basically, we said we want to put money into mutual funds, and ideally, like I said, in the pillars, you want to invest in sort of equity funds eventually for your long-term goals. So the goals have to be 5 to 7 years away before you can start thinking of equity funds. If they're any less than that, please consider balanced funds or even more
Mhm.
conservative funds. Okay, so depending on where your goals are, and so select your mutual funds accordingly. The second thing is then what you're doing is you're putting a systematic investment plan, SIP, into multiple funds. And please don't over diversify. Okay. So within equities, you can have 3, 4, 5 funds in total, large cap, mid cap, small cap, all combined. Ideally, you should simply have flexi cap. So maybe 3 flexi cap funds are what you'd want to invest in. And
Mhm.
that's it. No need to then also go large and mid and small. No need for that. Just buy three to four flexi cap funds. They need
All
to be
right.
of different styles. So that's another thing. So now what you want to do is put a systematic investment plan in those 3 or 4 funds. So
Mhm.
divide it equally and simply start investing in them.
All right.
Um, the SIP is a set amount. So you say, for example, you are putting away, say, 100 rupees a month. You saying, I'm dividing up into these 3, 4 funds and divide it equally, and away you go. Um, what happens is, like I said earlier, what it's easier to have lifestyle creep when you get an increment. So when you get
All
a
right.
pay increase, you might start spending more. To
Mhm.
prevent you from doing that, there is a psychological tool that people found that
All right.
save more tomorrow. That was a concept that has been prevalent in other markets, which in the Indian market they have turned into a feature. So the
All right.
SIP top up is basically saying that I'm committing to say 100 rupees SIP, but
Mhm.
next year when I get that pay rise, I'll commit to 120 rupees. So today only you're making a commitment that you in the future you want to sort of add a bigger amount to your SIP. And
Mhm.
so if you said that today only, it happens very quietly from your bank account. You don't have to sit there and actually activate that.
All right.
If you're very confident of your future thing. So that's how the top up plan works. It works fine. I think it's a great idea for
All right.
people who have that salaried sort of thing coming in. I think for a lot of people who don't have the sort of regularity of income, it's a little bit harder to plan. I must
Mhm.
say, I tend to sort of do lump sums because I'm self-employed. So it just varies depending on your situation.
All right. So, one last question before we wrap up. Actually, a quick one on SIP before I move on to the last questions, and that is about lump sum withdrawal. How does that work, and how does it help in better planning, say for an emergency or maybe even retirement planning?
So the question is, should you withdraw a lump sum or not? Is
Yeah.
that what you're
How does
asking?
that work? Yeah, and does that really help? What are the pros and cons of doing the same?
I think so basically equities tend to work best when you leave them untouched. Okay, so
All
when
right.
you have long-term goals of building wealth or education or long-term whatever, you want to put as much money that you don't
Mhm.
need to touch. And like I said, your goal has to be at least sort of 7 years away. Once you start getting closer to the goal, say, for example, I'm now in my 50s and I'm about to retire within 5 years. Okay. What I
All right.
want to do is to not risk that there might be a crash the year that I'm retiring. Okay.
All
Because
right.
then I have to sell at the wrong time. So, what happens is most people, when they're close to a goal, within
Mm-hmm.
5 years of that, they start converting equity funds into, say, a balanced fund, from balanced fund into a conservative fund, from conservative fund into a bond fund, from bond fund into a cash fund. So
Mm-hmm.
basically, you are trying to reduce the risk of a crash when you need the money. So that's one way of handling it, is to simply take the money out and put it into a different kind of fund. Okay. So
Mm-hmm.
then when you are ready to retire or meet that goal, or whether your kids' education, whatever, you can simply take that lump sum out. If it's in a bond fund or a cash fund, it'll be safe. So you will be able to take it out when you need it.
All right.
Now, on the other hand, when another way of handling it, this is one way of handling it. Another way of handling it is that when you retire, it's not like age 65 and all of a sudden you need all your money. ऐसा नहीं
Mm-hmm.
होता है life में, right? You have another 30 years to live. So
Okay.
another way that the world has invented is the opposite of an SIP, is a
Mm-hmm.
systematic withdrawal plan.
All right.
Because you don't need your money on day one,
Right
you're
away.
saying
Yeah.
you're going to live 30 years, you might as well stagger your, just like you staggered your inflows every month, you
You
stagger
can
your
stagger the
outflows.
output.
Okay, so you are going to only spend, say, 4-5% of your capital every year, and you
Mm-hmm.
simply divide that up into 12 months, and you say that every month I'm only going to withdraw this much. So you're only ever selling a small part of your capital. So
All
even
right.
if the market does crash or something happens, and if it's in a well diversified portfolio, to be
Mm-hmm.
honest, in a well diversified portfolio, the chances of a market crash beyond sort of 5-7% is very unlikely in any given year anyway, right? And you're
Sure.
not no longer in an equity fund, you're now in a balanced fund, or balanced portfolio. So then you withdrawing sort of a small part of that in a systematic withdrawal plan, it minimizes your risk that you have to
All right.
lock in when there is a crash. So that's basically, so SIP, top up SIP, systematic withdrawal plan, these are
Mm-hmm.
terms used in India for features of mutual funds. They're not products by themselves. They are
Mm-hmm.
not a definition. They are simply features that the mutual fund industry has come up with and has done an excellent job of popularizing so that people
All right.
understand. And there's a little sort of, yeah, a little abbreviation that you can use and quickly sort of use.
All right. So one last question, Hansi, for our audience. Is there a foolproof mantra or a smart and safe investment strategy that our audience can benefit from in order to achieve their financial freedom? So quick tips there just before we wrap up.
So the simplest, the only free lunch they say in my industry, in the investment industry, is diversification.
All right.
Diversification, diversification, diversification. Just like they say location, location, location in real estate.
Yeah,
In
that's
our world, it's diversification, which means that you should never, ever, ever, ever put all your money into anything. Doesn't matter how much someone tells you that it's guaranteed. Okay,
Mhm.
do not put all your money into anything. So when I see, for example, when things blow up, okay, and I
All right.
see the commentaries on these sort of internet sites, and people say, oh, my life savings was in that fund. I kind of
Mhm.
sometimes wonder, like, why were your life savings in one fund? I mean, how is that even possible in today's
Mhm.
world? How was that possible? So I'm saying to you that whether it's a asset class, whether it's a mutual fund, whether it's mutual fund provider, whether it's even sort of reporting, I would say diversify. Okay, so
All
don't
right.
over diversify. That would mean that leads to the mean, but there is a certain optimal amount of diversification, and please ensure that you are exposed to different asset classes. So you have some gold and real estate in your emergency, you have equities in your long-term portfolio, and you have some lottery ticket in your life to have fun. So that's the diversification. That what I explained to you with the house concept, the technical term for that is asset allocation, but
Yes.
I expanded into wealth allocation. So I hopefully I've explained that hopefully in simple English and people can
Yes.
understand. That's
Absolutely.
one. And second thing I'd say is, yeah, I think you need to sort of the one thing that will give you the most dividends is investing in your own knowledge. Okay,
All
so
right.
don't fall for finfluencers 2-minute video and 30-second video and ye reel dekh liya, wo de. Don't fall for that, because it's just dopamine effect. You really want to take a little bit of time. Please do your homework on my qualification, my background, your qualification, your background. Do homework on people that you can relate to, that makes sense, and then spend a little bit of time and understanding it. There's people like me. There are many, many more people who are able to spare time and give you answers to all these questions that you have. But please spend some time on your financial independence. I can tell you this. Okay, so when people have asked me, like, why don't you have a fancy car or a fancy house or a fancy this? You know what I have? I have financial independence, the ability to say no to a bad job, to a bad marriage, to a bad offer, to a bad project, to anything. Okay, I have the ability to say no, and I can tell you that's the best feeling.
That's
It's
the
the
feeling
best
of empowerment. Yes.
feeling. I can tell you, the fact that I can say no to people is amazing. So just make sure that you are deferring your current instant gratification for a
Yes.
future outcome, and make sure you balance your life. Okay, you can't completely be hoarding just for the future and not live in the present, but it's a little balance, and that's something that I think where philosophy will help. So a little bit of investing in your own happiness and philosophy will also be very good.
Great. Thank you so much. That was Hansi Malhotra, founder and editor, Money Management India, sharing very important tips on how to achieve your financial freedom. And as she said, start early, save for your future, invest in your knowledge, invest in your happiness, create an emergency fund. Remember to diversify your portfolio, and definitely don't put all your eggs in one basket. So thank you all for watching, and thank you so much, Hansi, for sharing all these tips.
Great. Thank you. Thanks for inviting me. Good to be here. Good to chat.
Absolutely. Great to have you. Thank you.
Bye.
दूसरा रन लेने की कोशिश, लेकिन ये रन आउट।
चाचू रन आउट।
कोई जरूरत नहीं थी रन लेने की।
इन्हें तो साथ भेजना ही नहीं चाहिए था।
कौन मैदान पर आता है?
अब अगला कोई एग्रेसिव प्लेयर आए तो सही होगा ना।
अरे अग्रेसिव तो खड़ा है ना स्ट्राइक पे भैया।
कोई डिफेंसिव प्लेयर आए तब तो जोड़ी बने।
लेफ्ट हैंडेड बैट्समैन की जरूरत है। लेफ्ट हैंड और राइट हैंड का कॉम्बिनेशन बॉलर्स को भारी पड़ेगा।
और ये कैप्टन का सही डिसीजन, लेफ्ट हैंडेड बैट्समैन की एंट्री।
सही जोड़ी ही मैच जिता सकती है, इसलिए जब हो आपका टैक्स प्लानिंग का मैच, आपको चाहिए टैक्स सेविंग्स और वेल्थ क्रिएशन की सही जोड़ी, जो आपको मिलेगी ELSS फंड के साथ। जब जोड़ी राइट तो फ्यूचर ब्राइट। ICICI Prudential म्यूचुअल फंड, तरक्की करें। Mutual fund investments are subject to market risks. Read all scheme related documents carefully.